Hello and welcome to a brand new show of Markets and More. And I guess on this edition of Markets and More than markets, we'll have to focus on more. What more can be done to really fix the economy, arrest the slowdown, and lift the animal spirits which are missing in the system? It does not look like a bear market for the Nifty, but it certainly feels like a bear market for small and mid cap stocks. But good news and good prices, they rarely come together. Markets, they always follow a cycle. And is the current cycle a cycle where if you participate couple of quarters and couple from years now, will you be duly rewarded? Let's discuss all that and much more on this edition of Markets and More with Sunil Singhania. Sunil, what's going on?
No, I think as you rightly said that Nifty is not reflecting the pain, and we all know it's been widely discussed that the pain is more in the broader markets. And I think there is some logic to the pain also. So we started off 16 and 17 with a big boom in the mid and small caps. Prices went up through the roof. A lot of it was I think much beyond fundamental. So some correction was obviously needed. And it also coincided with some tough calls which the economy had to take from the longer term perspective, changing the way the business is being done. It also coincided with obviously issues with the banking and the NBFC segment, and credit became very tough. So I think all these are known, and on top of it, when all these things happen towards the end, the sentiment just goes for a toss. So I think what we are seeing over the last couple of months is more the sentiment going completely towards the other side. So the way 16 and 17 was a period where sentiments had run much ahead of fundamentals. I think we are now coming to a stage where fundamentals are running much below the fair market, and the earnings season has also not been great. So it's just sort of helping the so-called the bear view makers, or even the doomsayers, so to say.
So ultimately markets are a function of economy. Like Buffett says that ultimately stock prices are slaves of earnings. Earnings are not there. We are in an earnings bear market. With each passing quarter with each passing year we start the year with a high number, and by the end of the year we cut it down drastically. This year is no different. And how does one understand that equity markets will come back when earnings are likely to contract further?
No, you are exactly right. Markets are all about earnings. And for the last 2-3 years, all of us, including me, have been propagating that yes, the next 6 months are going to be tough, but then the earnings will recover. And that's not happened. Frankly, this quarter there was expectations, largely because the corporate banks were looking like turning around, which has happened. So banks like Axis, ICICI, even State Bank have reported a turnaround in their earnings, and hopefully as we move forward that would happen. But some of the other larger companies like the telecom side, or even on the auto side, has seen a big sort of a headwind, and that has damaged to some extent the earnings trajectory. Having said that, one interesting aspect of the quarter's earnings, June quarter earnings, is that one, we still have positive earnings growth. It is a small earnings growth. Second is on the gross profit margin across segments, we are seeing quite a bit of stability, which is very unlike the slowdown which we saw in 2001 and 2003. So one is the balance sheets of the company more or less are very, very good. You remove the companies which are facing stress and who are going to go down under because of excessive borrowings and sort of mishaps. But by and large, the broader markets, if you see, a lot of companies have the debt equity ratio much below what we have seen, and they have used the last 2-3 years of good prospects to reduce their debt levels, and the gross profit margins have been maintained. So our expectation is that once the top line grows, when the demand starts to come back, which hopefully it should, it's not as happened, but it should, then the profit growth can be significantly higher than the top line growth. And a couple of places where there can be a tailwind in terms of profitability would be lower interest rates and lower costs, both as far as fuel is concerned because of oil prices going down, as well as raw material, because by and large all commodity prices have also corrected quite significantly. So we remain quite optimistic.
Okay. Now markets, they always follow a cycle. We can look at history and then connect the current environment. What you are saying is that the current environment does not look like 2008. That was scary. environment, but it certainly smells of 2013.
So, in terms of the large cap and mid cap, it is exactly a mirror of 2013. So, if you remember 2013, again Nifty was flattish, but mid and small cap indices fell 20 to 30%. And there was a time between August of 2013 to October of 2013 where the country seemed completely lost. We were heading to an election which was supposed to be very uncertain. Rupee suddenly, overnight depreciated by 15% odd. The foreign exchange reserves were very precarious. Government had to, have State Bank of India issue dollar bonds to replenish those, foreign exchanges. And stocks had fallen completely out of whack because largely earnings were not there. The only difference this time vis-a-vis 2013 is that the mid and small caps are still not as cheap as they were in 2013-14. They're quite cheap, but 2013-14 they were like very, very cheap. And therefore you saw the next 3 years the small cap and the mid cap indices go up 3-4 times. This time we don't see them going up 3-4 times, but we definitely look at prices now and there is decent money to be made. But if you compare the scenario, I think it is similar in terms of markets, but in terms of the economy, we are much, much stronger now than we were in 2013 and 14. So currency is very stable. In fact, rupee is at the same level as it was in 2013, which was 69. Foreign exchange reserves are at $430-40 billion, which is an all-time high.
It is back to 60.
And oil is at 57, 58 and looking very, very weak. On top of it, we have a very strong government with a majority significant majority in the lower house and hopefully a majority soon in the upper house. Politically, we are very stable. I think in geopolitical terms also, we are pretty okay. I think all we need is the economy kicking back in terms of growth rate and corporate profit to follow.
Do you think the markets and the economy will get worse before it gets better? Right now it's bad. Will it get awful before it gets better, or the rate of change, which is what we focus on in markets? We are nearing the fundamental bottom and we are nearing the end of the price decline.
So let us just divide it into two, the economy and then the markets. I think as far as the economy is concerned, we are getting to the bottom. Maybe the next 1 or 2 month numbers might also not look that great because this is a low sort of a growth period anyway. Monsoons have been pretty, widespread and aggressive. There have been some states where there have been floods. So, and normally the activity during this period slows down. It is only when the post-monsoon, when the festive season starts, which will be mid-September, October, that you will start to see the economic kickstart. The other thing is the budget this time was in July, unlike in January. And typically it takes 6 weeks after the budget for the ministries to start focusing on their allocation and therefore the spending. So all the government spending on infrastructure should now start post monsoon, which will again be a big kicker as far as the economy is concerned. And I think the third thing is liquidity has come back into the system. So if you see the bank's balance with RBI, it's like at a 3-4 year high at almost 2 lakh crores. It's not been transmitted because there is this fear, but once that fear goes away and also the interest rate fall also gets transmitted, that will also cause a kicker as far as the economy is concerned. On the other hand, I would say the markets are now looking at bottoming out. Maybe over the next 2-3 months is a great time
both for large cap and mid cap.
I would say more stocks which have fallen. So even in large caps, you have a very different kind of market where one segment has not fallen, which is holding on the market.
But in terms of
but I would say go into stock specific, whether irrespective of the market cap. But obviously the small caps and the mid caps have fallen the most because there's also a technical reason and there is more fear there, and they have fallen more. But I would say that stocks would start to react much faster and in advance. So I'll just give an example. People all talk about motor car sales. So we have seen for the last 4 months, Maruti report a 25-30% degrowth in terms of car sales, and therefore the prices have also fallen of the stock by almost 40%. Imagine 1 month, only 1 month, where the numbers again start to look at 120, 130. And then again, the spreadsheet will completely change from 105,000 cars a month to 120-25,000 cars a month. All it needs is 1 or 2 months where the sale numbers start to come in. So I would say that stocks might sort of precede the economic recovery. All we need is 2, 3, 4 good news in a couple of segments, and the sentiment will change completely.
In one of your notes, you are comparing the current environment with Bollywood movies. So let's talk about it. Jo dar gaya so mar gaya. What does that mean?
So I think what we were just discussing in the office, and when you meet people, I meet investors because we are raising the second fund, which is more mid cap focused and small cap focused, and which is very difficult to even convince investors. I think one thing we realize is that all these cliched presentations which we make on the global economy, on India, demographics, is now everyone knows by heart. So what we try to do is use Bollywood, because that is one thing which everyone follows in India, and try to have some famous dialogues and give their perspective of what is happening in India. So you mentioned Jo dar gaya or mar gaya. I think fear is more now, and even in a lot of companies which are now trading at below book, below intrinsic value, below replacement cost, largely because the near-term outlook is slightly muted or not good, but which still have profits, which
So it's
still
time
have
to
good
take
growth.
risk.
It is time to take risk. Unless you do that, how are you going to make money? So either you be an investor who doesn't want to take risks in terms of the profitability, in terms of the economic environment, and invest in 2017 when the prices are not worth taking risk, or you take risk now when the economy is slightly struggling. There is a little bit of a hazy outlook in terms of near-term earnings, but prices are more than discounting that. The investor has to choose whether they want to invest in 2017 or when they want to invest now, in the prices of the same stocks I have fallen 50-60%.
But what I liked about that presentation is about my favorite movie, Three Idiots. I love that movie for obvious reasons. But you picked up an example where you say that when others are in trouble, we feel happy.
Yeah, so in Three Idiots it says, those fail hota hai to dukh hota hai, but those first aata to zyada dukh hota hai. I think what you have tried to relate is that there are some factors in the world which are negative. So you have trade war issues which are impacting some countries. Then you have oil prices which are falling, which is impacting some countries. And then you have a scenario where, for example, currency or low interest rates. Like you have $15 trillion of assets which are in negative interest rate in the world. All these are positive for India. So if oil prices fall, it's positive. If trade wars happen, India is the least impacted in terms of their exports, but indirectly impacted if you are able to attract those companies to set up facilities in India. And most importantly, India still has a fairly good interest rate with a stable, foreign exchange reserves. We have never defaulted ever in our obligations globally. I don't see a scenario where the country has a problem and interest rates are falling in India. Our foreign exchange reserves are very stable. We still are net recipients of foreign money if you look at FDI. And I think that others' problem can in fact become a boon for India.
So a year from now, we can say the famous punchline of Amir Khan, all is well. We may not say it right now, but a year from now, you think we'll say it?
I think we have to all start to convince ourselves that all is not as bad as we are making out to be.
For the economy and for the markets.
I would say both will go hand in hand. Markets might, as I said, precede the economic recovery.
If not a very large permanent bottom, fundamentally we could be reaching a bottom. See, 10% sell-off could happen because of technical factors, Dow, trade war, Brexit. But fundamentally speaking, 10% is there to lose, and 30% is what you can gain in next 12 to 18 months.
I don't know how much is to lose or how much to gain. I would say the risk reward is heavily loaded in favor of investments. So your chances of losing are much smaller than chances of gaining. Another interesting study which we are doing right now is just comparing the conditions of the company in 2014 to 2019. And there are so many good companies. I'm not talking about companies which are obscure. Good companies which have market cap similar to what they were in 2014. But the size of those companies in terms of sales, in terms of operating profit, in terms of debt equity ratio, in terms of net profit is 2 or 2.5 times of that was in 2014. So technically, you're buying those companies which are double or 2.5 times the size in 2014 at the same valuation as it was in 2014.
Just for viewers, ultimately, and not for a sophisticated investor like you, just for our average viewer, ultimately when you're buying a stock, you're buying future profit. The point what you're making is that if you're buying some good NBFCs and barring consumer durable company, you're buying them at market cap and profit levels as low as 2013 and 2014.
With no business valuation built in. So suppose if you buy an NBFC, for example, at one time book, you are basically giving zero value to the whole franchise.
So gold is suddenly available at the price of silver, to put it very simply.
I don't know about that, frankly. I don't want to give hopes that the prices will go up by 10 times. But our competition is now with the alternative opportunities. So real estate I don't see is going anywhere. Fixed income, you make 6.5% in fixed deposit and you give 3% as tax. So you're left with 3.5%. I think equity from these levels should do significantly better than these other asset classes. And as I said, it's always good to buy when the prices are low rather than when the prices are high.
In a reverse swing segment, this time you were talking about pharmaceutical. Now again, this is one of those rusty sectors. There are genuine concerns at the operating level, at the company level, at the manufacturing level. Why are you happy to stick your neck out, literally stick your neck out and say there's a case to buy pharma structurally and selectively?
So if you just go back in history, pharma, the big run in pharma stock started from 2008 time and it lasted till 2016. And if you see the genesis of that was pharma as an overall sector, the market cap of the whole pharma sector in India was less than that of DLF in 2008. And it was like a screaming buy with prices very low, and there was this huge tailwind because a lot of drugs internationally were going off patent. By 2016, you were looking at pharma companies which were trading at 40 times trailing and 50 times trailing. And then you had a lot of headwinds. One was the growth slowdown because the generic prices started to fall. You had a big headwind from US regulatory issues where almost all pharma companies had some or the other plant go in for import alert or restriction as far as is concerned. And then as a result of which the growth slowed down and the PE multiples fell. I think we are coming to a stage when it is getting interesting. I'm not saying that go ahead and buy anything and everything in pharma tomorrow. I think pharma has become more individualistic in terms of the companies which you invest in, but the regulatory headwinds are receding because the companies in India have also realized that they can't use shortcuts. At the same time, a lot of these plants had issues and 2-3 years have passed and one by one they're coming off out of the issues. Second is the pricing pressure, particularly in the US, is receding because if you see the US generic companies, whether you look at Mylan or Teva or some of the other ones, their debt levels have gone crazy. And that is the reason you had this big deal of Mylan and Pfizer also. So the ability for them to keep on selling at lower prices is reducing. In fact, prices have started to move up, which should be good for India. We have had a 2-3% fall in the rupee, which again will be a tailwind for the pharma. And I think valuations are now in your favor. So you're getting large companies at 15 PE, which was like unheard of. These are high ROE companies. You don't have concerns of debt being very high in a lot of these pharma companies. So it is becoming interesting. So I think selectively, it makes tremendous sense to start looking at them and maybe over the next 3-6 months create some exposure to that segment.
But buy US facing generic companies, to put it very simply.
No, I think Indian facing companies are also interesting, but they are very expensive. So if you look at multinational companies, pharma companies in India, in fact, over the last 1 year, they've moved up 20-25%, and they have significantly outperformed the exporting companies, which was reverse. So I think there will be some movement again back to these generic companies which are more US facing.
Sunil, we are talking about a anemic and acute slowdown in the market, and typically when the slowdown starts, you will always sell what is expensive. That's the simple commonsensical approach. But if I look at Asian Paints, it's sitting at a 52-week high. Bajaj Finance, NBFCs have melted down, but Bajaj Finance from the recent low, which was sub 2000, now is at 35-3600. I looked at Trent, the P multiple has gone to north of 80 times. DMart is still standing tall. Why good quality stocks in this fall, which should have corrected, have become more expensive? See, you can always find exception, Aisha, Maruti, those are autos, that's a genuine problem. Others?
No, I would say that some of the expensive stocks in other sectors have also taken a beating, like Page Industries and some of the other Shankara or whatever, they were like the darlings 2-3 years back. So it's been mixed. One common trait in stocks which have not fallen is that even in these kind of scenario, they've been able to maintain some growth, whether it is 10%, 12%. And one thing we have to remember is that in the mutual funds, money is still coming in. There has been net inflows. And I think obviously portfolio managers do get impacted because they have to show the near-term performances on a monthly, daily, weekly basis. And there is a natural tendency in these kind of markets where there is so much uncertainty to go into companies or stocks where you are feeling or getting that feeling of safety.
Is there anything wrong in it? Because that strategy, frankly, has made money. Asian Paints was expensive 5 years ago. HDFC Bank was expensive.
So there will always be exceptions to those rules. But I have seen Hindustan Lever, for example, between 2000 to 2008, making zero returns.
ITC is not giving you returns.
ITC last 5-7 years has not given you returns. Obviously Asian Paints and Hindustan Lever and Nestle are the exceptions. But we have seen other companies like Britannia fall and Page Industries fall and Eicher fall and Maruti fall. So it's been mixed. As an analyst, I think there is this concept that the stock prices should ultimately, or the stock valuation should ultimately reflect the future earning potential. So I think if there are this case of a company growing only at 5-7%, trading at 50p, obviously at some point of time this is going to break down. But if you have companies which are trading at 30-35p and still growing at 15-20%, maybe you can justify it. So I think even in this high P sort of companies, you will have to distinguish that which are the companies which are trading at the levels which they are trading today because of technical reasons, which is money flowing into those companies. There is no dilution, so the pool of money has to chase a limited availability of stock, or you basically invest in companies which are discounted compared to their future earning potential. I would say that we would go in for the second kind of thing. In fact, the second fund which we have launched has 3 criteria: 15% or more ROE, 15% or more growth, but less than 15p. So for us, this basket is untouchable.
Okay. Now, we spoke about delivery apps and the impact of that. Then we spoke about UPI. But this time, according to your analysis, the reason why SIP is doing well is because the millennials in India, they prefer SIPs. That's a mega trend in making. That's reflected because now markets are cracking, but SIPs are strong.
So again, if you go to our own history and families, I'm sure that our parents and their parents never even looked at equity as an investment. There were 2-3 reasons. One was savings were not available. Their whole salaries or income is to go in meeting the basic roti, kapda and makan for their family. Second is awareness was not there. And third, at that point of time, equity markets was perceived to be like a gamble rather than an investment avenues. I think over the last 20-30 years that has changed, and a lot of credit is to be given to media, to the mutual fund industry who have popularized this concept of investing regularly. And the new generation, one, they are aware. Second, they are making decent salaries even at a young age, and therefore they have disposable income to be invested. And technology has made it very easy. At one click you can invest. You don't have to fill 20 forms like you had earlier. So I think it's a combination of these things, and which is very, very healthy. So I think if we are able to channelize more savings, which goes into equity markets, this over-reliance on foreign flows, which has already come down, will come down further. And this can only go up because now you have this robo-advisory firms and this online firms and companies like Alibaba in China becoming one of the biggest asset management companies in China. Hopefully in India also you'll have 2, 3, 4 of those kind of platforms available which will make investing easier. And there is now transparency. People trust the mutual fund side or the organized way of investing side.
Alternates are doing poorly. That's also one factor which is at play. Real estate, gold, frankly, the alternates have not given great returns.
I would say that is more cyclical. Maybe after 4-5 years that might change. But the investors have realized that they need to have a balanced portfolio. Earlier 90% used to go in real estate, 10%, 15% into fixed deposit, and that was it. Now even the investors have created family offices, the large investors. They know the virtues of having a balanced diversification as far as their savings are concerned. And I think that is also a very positive thing going forward.
Sunil, appreciate your time. We've covered a range of topics. We started the show, we discussed elections. Today we're discussing slowdown. Hopefully next time we meet, let's hope we're discussing good news and a better environment.
We'll always have good news in India if you have a longer term view. Thank you.
Appreciate your time. That's it on this edition of Markets and More. Thank you for tuning in.